Why are banks all over the world cutting rates, but the Fed likely will not? Have these other banks solved their inflation problem, or is their weakening economies more the focus? We're going to dive into that all today.
Yeah, it's a big deal, right? Because typically the Fed does something and then the world reacts, right? Like everybody says the U.S. sneezes and the rest of the world gets a cold. Well, this is not the case today.
No, we have, the Bank of Europe, the
ECB.
Yep, ECB, Switzerland, Sweden, and the Bank of Canada all cutting rates 0.25%. And we're almost positive when the Fed meets this Wednesday, they won't be cutting rates in the U.S.
Yeah, so as you guys know, like everybody's hoping for under 6% rates. I just don't see it. First of all, I don't think we're going to get a rate cut this week. And there's a couple reasons why. And this is meaningful because a lot of people that are underwater, especially on the commercial real estate, which is what we're dealing with, are trapped. They're hoping for lower rates. I just don't see it. I do think that maybe politically might see some toward the end of the year, but it doesn't really even matter at this point. Some people say there aren't going to be any. But the reason it's important is because there's a lot of trapped equity sitting in these single-family houses. Refinancings are dead. New home sales are dead. And a lot of these people can't get out of these big commercial projects because of the rates are so high, right? It's all has to do with this 2% target inflation rate, which the Fed has admitted that they're worried about still.
Right. But they're maybe not as worried as they were. So that's what we're kind of seeing in these other countries. They're lowering their interest rates. So one might assume that they hit their 2% inflation mark because we've heard a lot about that. We have to hit 2% inflation. It's, now is the time. This is the biggest threat to our society, blah, blah, blah.
But they're not.
But they didn't hit their 2% inflation mark. So that's something we've been mentioning on this channel is we expect the Federal Reserve as well to accept higher inflation. The Bank of Europe is accepting a 2.5% inflation rate, and Canada currently sits at 2.7% inflation. It's funny because the ECB said that they're not fully giving it up because now they're saying, well, we expect it to fall to this year and it'll be 2.1% by 2025. So they're not giving it up, the shtick, but they are lowering ahead of inflation falling.
Yeah, I think there's a couple things to consider here. The reason why this is important is that the ECB has not cut rates since 2019. So let me repeat that again. They have not. Their last cut was in 2019. So this is a big deal because typically the Fed kind of leads, and then the other banks kind of follow. The other central banks kind of follow. Now, to be fair, they hit 10.6% inflation in October of 2022. The ECB and Europe. So I think that's a big deal, much higher than we have, but they've released earlier. So it's very, very interesting.
I think it's good to note, though, that spending has slowed more in these countries than it has here in the U.S. Because here our consumer spending is still pretty high. And also their unemployment is a little higher than ours is. So I do think that is worth noting that they kind of went ahead and did that. But, when they start to lower these asset prices, I'm asking you, these rates, that's going to make asset prices and things increase, correct?
High interest rates restrain economies. That's exactly what it does. It's to slow inflation. That's certainly worked. You can't go from 10.6 or 9.1 where we were all the way down. So that's actually working. But if you guys look at these, as you guys know, first of all, I was never very good in school. But I do like to read this stuff. Call me a geek. This is the beige book, and these are the minutes of the Fed Open Market Committee on May 1st. So it's really important to really understand what's going on here. And the Fed is clearly concerned about inflation still. The one big wild card in all of this, I think, is unemployment. Now, if you look at, there's something really weird happened in May. Like really, really weird. So there were 272,000 jobs added in May. So imagine that. Okay. Most people think that's good. That's way ahead of the projections. Yet, the unemployment went up to 4%. So unemployment went up, but yet they blew expectations by over 100,000. So doesn't that seem odd? And if you look at the number of jobs, and so this is precisely what the Fed does not want. Actually, it's the opposite of what you think. Now, the Fed's target unemployment rate is 4.4. It went from 3.7 to 4. So oddly enough, the unemployment rate went up, and so did the amount of jobs. So it's an interesting thing.
But I think you need to. So Jerry, can you play our first clip? The Fed cut, please.
But the Fed is going to be, we think, cutting later this year, not necessarily for the reasons the markets are expecting, which is sort of benign disinflation, but because we are going to start to see, if not this morning, then in the next couple of months, more weakness in the labor market. It's going to force their hand and bring them to the table with interest rate cuts.
I don't know.
So essentially, the job creation is lowering. I think that clip kind of ended a little bit soon, but Jerry, if you want to play the next one.
But the Fed is going to be, we think, cutting later this year, not necessarily for the reasons the markets are expecting, which is sort of benign disinflation, but because we are going to start to see, if not this morning, then in the next couple of months, more weakness in the labor market. It's going to force their hand and bring them to the table with interest rate cuts.
Though you're having some doubts about the U.S. achieving a soft landing. The thing that you're looking at is employment. I mean, straighten me out because I don't quite get it. Sequentially, we're expected to see an increase in jobs. What are you seeing that economists in the market aren't seeing when it comes to the jobs market?
Sure. So the payrolls have been very strong, really, in the last year or 2 years, but we have seen sort of this gradual decline in job creation, which is going to be natural the later you get into a cycle. It's the leading indicators for employment that really concern us. When we look at leading indicators for the unemployment rate, because again, the unemployment rate is not a leading indicator. Once the unemployment rate is rising, it tends to mean it's already a little bit too late for the Fed to step in and help the market or help the economy with interest rate cuts. The unemployment rate is higher by about 0.5% than it was a year ago.
Yeah, but wage growth is higher as well. But wage growth is higher. So generally, if the labor market's softening, why would wage growth be so strong? I believe it's about 4% year over year. Why are we seeing wage growth if the labor market's actually soft?
So wage growth is also decelerating. So the two things that we look at together are the quits rate. So how often are people leaving their jobs voluntarily? And that tends to lead wage growth by about a year. And the quits rate's been coming down pretty rapidly over the last year as the market sort of normalizes, and even quits now are a little bit less common than they were before the pandemic. We think that's going to continue to bring wage growth down. That's a sign that the labor market is not as tight, despite the headline payroll growth. The labor market is not as tight as it was, again, a year ago. But things like small business hiring, how many small businesses are saying they're going to be hiring in the next 3 to 6 months, that's really started to come down pretty significantly as well. And that has been historically a very reliable indicator for a rising unemployment rate.
So I wanted to show you that video because I think it's important to note, some information behind the jobs numbers. So they're like he said, unemployment is the last thing that's going to give. There's a lot of indicators that employment is slowing down, and that's going to obviously affect the Fed's decision as well moving forward.
Right. But I also want to point out something. We did a video last week about immigration. And there is a mention in the Fed minutes on page 7 for any of you guys want to fact check me. It's on there. It's on their website, by the way. You can just print it. This is interesting. Participants further commented that the recent estimates of greater immigration in the past few years and an overall increase in labor supply could help explain the strength in the employment gains, even as the unemployment rate had remained roughly flat and wage pressures had eased. So what they're saying here is exactly what's going on in Canada. As you guys know, Canada brought in over 1 million immigrants in the last 2 years, and it's put significant pressure on housing prices. The average house price in Canada is $791,000. And if you could take a look at Toronto or Vancouver, they're even significantly higher, well over in the millions. And so why is that? So, the amount of people coming in put pressure on everything. And in this particular case, wage growth is severely impacted. And there's all kinds of paper on this. Like this is a controversial topic. But I think it's an important one. Because you've got inflation, you've got wage growth, and you've got unemployment. So unemployment actually went up, yet we added the number, which you gotta question that.
Yeah, absolutely. And I do think though that when the Fed lowers rates, to get back to all these other countries lowering rates, it may not be because of our employment rate. So they may lower it sooner because there's going to be pressure from these other countries that are lowering rates to have the Fed lower rates because they can't divulge that much from the Fed.
Right, which is the point of the entire conversation is that the ECB came out, the Bank of Canada came out, and so now the Fed's it's going to be interesting this week on Wednesday.
Well, yeah, and then on Wednesday, just based on the research that I've done and we've done, I don't think that they're going to lower rates yet because, these other governments are only a quarter of a point different than went down a quarter of a point. But moving forward, they're going to want to lower more. So the question is, though, why are these other economies accepting the higher inflation and not keeping rates the same? Why are they lowering rates? So you have to kind of take a look at that, too.
Well,
right?
But you also have to look at the growth, because that's one of the things. So GDP, let's call it. So Q1 was 1.3, and that's down from 3.4. So we talked about stagflation before. Now there's three things for stagflation. One is high inflation, two is low economic growth, and three is high unemployment. So stagflation is worse than recession.
Right.
It's worse. And there's only been one in the history of the U.S., and it's been in the 70s. And so, if the Fed does lower rates, what is that going to do? It's going to create asset appreciation again.
It is. But I think Jeff Snyder's theory on this was actually really interesting because he's like, a quarter of a percentage is not going to really do much for anybody, right?
I agree with him.
But what it does is it's not meant for the individual, right? Like a quarter of a point, nobody's even going to notice that on anything and nobody's going to refinance over that. But it's signaling for corporations. So that's what it's doing. It's signaling to them, hey, we're easing up. Don't fire your employees. Don't let anyone else go. Start hiring. It's all going to be okay. Don't worry about this. So in his opinion, and of all the research I've done, I believe he's correct, is it's a psychological thing, right, for corporations. Because what they don't want is mass layoffs. And what they don't want is, people not being able to afford to spend because that will create stagflation. So all these governments are kind of signaling to corporate, and now these governments are going to be signaling to the U.S. that they want rate cuts. And I think that is what's going to push the U.S. to do rate cuts in July or September.
Yeah, that's a possibility. I remember hearing him say that higher prices turn into higher wages, which in turn turn into higher prices, which in turn turn into higher wages. That's the truth, right?
Yeah.
And the one thing that drives all of this are interest rates. So, as corporations finance things and as consumers finance things, it gets harder for them, period, right? And so then they demand more money from their employer because things are more expensive. That's how it works. Mm-hmm. And then the employer has to take a look at, does this work? How, because the one thing that's not going up are revenues.
Right.
Right. So wages are certainly not going up. And I think immigration is a wild card here because it's going to pull down that wage growth. You can't add millions of people into an economy and don't think that they're not going to try to be working. Right. Period. Right. And so that's going to pull down that. It's just It's just going to be a really, really interesting thing to watch. But I don't think the Fed's going to increase rate or cut rates this week. And also, as I've said before, I think this is a little bit of this is meaningless. You know, because there's the rates when they were significant were in the 4 range.
Right.
We're so far above that.
But that doesn't mean we're not going to cut more rapidly, because when you kind of read some of this information and listen to people like Jeff Snyder that's been, researching this, they think that there are going to be substantial rate cuts, because he thinks that they're now going to start focusing on stagflation versus a recession versus inflation.
Yeah.
And they're also going to claim victory on inflation, as they are, because even the Bank of or the ECB came out and said, right now it's at 2.5%. We expect it to be 2% next year. So we're lowering rates and all is well, right? They're kind of packaging it up.
I think that's fair too.
Yeah.
I mean, they have. I mean, they brought it from 9 to, let's say, mid-2s. Mm-hmm. I think that's good.
But it also, if they're going to start lowering rates again to avoid stagflation, they're also accepting a higher inflation, because the inflation rate very well could go back up with lower rates if they continue to lower.
It's possible. In this beige book, for those of you guys who aren't familiar with it, 8 times a year, each federal bank summarizes the economic activity of that bank, of what's happening. And I went through this, and I'll tell you what, it's flat auto sales, flat retail spending, flat housing. The one thing that went up was tourism strength, but they're all worried about the summer. Tight credit, all that stuff. And I'll tell you, the one big wild card that nobody's talking about yet are the banks. And what's interesting is on the 26th of this month, the Fed is releasing a bank stress test. This is going to be really interesting. So it could be that they're just trying to get past this with no cut. And then the stress test is going to be released. The other thing, don't forget, CPI is out on Wednesday. Mm-hmm. So isn't that interesting that the CPI report is out at 2:00 and Chairman Powell talks at 2:30? Do you think he maybe had access to it before?
All right.
So, there's a lot going on this week. I think it's really interesting. And the month of June, too, because the bank stress test, that's kind of the wild card. They look at the private sector.
Yeah, and I think, what we're going to see from the Fed has been what we're seeing from these other countries. We're going to have higher inflation. They're going to accept higher inflation. We've been saying on this channel for a long time that they're going to accept higher inflation because they're trying to avoid stagflation, right? That is this siren that is now going off that all these countries are trying to avoid. So because of that, and what we try to teach all of you that listen is during times of stagflation, we did a video on this. You want to be in hard assets.
Correct.
You want to be in gold. You want to be in
Correct.
real estate. So that is what we're going to be seeing. Just expect that you're going to have a higher than normal inflation for some time.
Could it be that the reason gold has had this spike, when it went from 1900 or 2000 to what is it, 2500 now? Like it's just 4 months, 5 months? Okay. Could it be that some of the insiders might know that and they're getting into hard assets to hedge the dollar and to hedge inflation? I don't know. But it's an interesting thing to think about. One thing that is a fact is that gold has gone up a lot. So I'm not advocating to go out and buy a bunch of gold. What I'm saying to you is you should be in hard assets if we're heading into periods of high inflation.
So I have a question for you that I know a lot of people are sitting on. So if we're anticipating rate cuts by the Fed, even if it's just a 1/4 point in this summer or this fall, should they be buying a home now, or do you think when they start to lower rates a 1/4 point, housing prices are going to go up, or do you think they just wait it out and just...
Yeah, I don't think it's a good question, but I as you know, I don't try to time the markets.
Right.
Like if it cash flows today based on today's rates, we're in escrow on a big project in Las Vegas right now. So it cash flows on today's rates, fixed. So if my property cash flows, the one that we're buying, and rates go down, great. That's a huge win. But you can't bank on that. So I'm hedging the up, and then I'll refinance on the down. So you always just got to take a look at, does it make sense for you to be able to do that? I think the residential market, which is different than the commercial market, is going to go through some temporary softness, but I don't see any relief in sight. I mean, like we think in the 400s is high. I mean, just take a look at Canada. They're in the high sevens. I'm not saying we're Canada, because we're certainly not. They only have like 40 million people or something. But the reality is it's a very interesting thing to watch as you start to mess around with their central bank and immigration, all the things, and the restriction of supply and all the things that they've got going. It's crazy to me that there are cities that are in the low millions as an entry, and we've had those. But it's really, really, really interesting. So I don't see any relief on the single family side. So if you can afford it, today's rates are historically about average. Knock yourself out. I always, but if I'm buying rental real estate or investment real estate, I always make sure it cash flows. So if you're trying to bank on lower rates, that's a huge mistake. If you're trying to see if cap rates are going to go down, huge mistake. We're going to have some, turmoil for the next 18 to 24 months as all this new construction hits. It's going to be a great time, I think. And we're also starting to see a little uptick in the MLS, which is also good. So higher supply creates price softness. So, in fact, Danille and I are looking at a house, and it's been on the market for
266 days.
266 days, one house. Okay, so you don't hear those stories all the time, but it is the truth. So why would that be? There's all kinds of reasons, but not everything is what it was. As you guys know, there were lines of people bidding up prices well above list. So that's all gone, and now it's kind of reversing back the other way. And as George Gammon always said, he always had the greatest analogy. He talked about hot air balloon. He said a hot air balloon. It goes up, that's inflationary, but it could have a hole in it, which could also be deflationary. So you can have inflation and deflation going on at the same time. So when we're throwing around these numbers, you got to look at the whole picture, right? You got to look at energy, you got to look at housing, you got to look at food, you got to look at all of the things that make up that number. And that's what the Fed's looking at. And I'll tell you, it just, to me, looks like inflation's here for a while. It's certainly not going to get harnessed anytime soon.
It's not, no. And if you're looking for investment opportunities, you should check out Limitless. We have that coming up at the end of August.
Guys, that's going to be great. We got 50 speakers. We got 3 stages, 2,000 people. This typically sells out. This is our 3rd year. We should have hopefully about 2,000 people at this, and 80 exhibitors. It's going to be fun. And by the way, the whole focus on this is going to be the uncertainty of what's going on. We're bringing in people to be able to talk to you about oil and gas and gold and silver and even Bitcoin and crypto and obviously starting a business and then AI. I can't wait to hear Eric Sue. If you guys don't know who he is, you should look him up. He just did 2 incredible interviews, one with Gary Vee and one with Alex Hermosi. I'll tell you, those are amazing. And it just talks about what is AI doing today and how can you apply it to your business. So we have some really, really, really good speakers there I'm excited about. We got Pace Morby in the house today.
Yep.
Doing a podcast on that. We got Chris Martinson talking about hard assets. So it's definitely worth it. If you guys are confused, as we all are, and where things are going, don't miss Limitless.
And use Ken10 to get 10% off.
Yep.
So let's jump into our premium questions here. So we had some good ones today. So Sherelle is asking, how much do you want a property to cash flow to make it worth it?
Yeah, it's a good question. So here's the way to look at things. If you can buy it, well, I guess the 1-month treasury went down. Let's just say it's 4.5. I don't know what it is today. I haven't looked lately. But if you have $100,000 sitting in a bank and you're making 4.5, almost risk-free, it's backed by the government. You got to imagine that thing produces cash flow of $4.5 or $4,500, right? That's what that is. 100,000 divided by 0.045. Okay, so when you look at cash flow from an investment, you have to realize that is it riskier to be in a piece of real estate that produces, say, 5%? Probably. So you're going to want, you're always got to measure it with what you're doing today. So what's the cost of the money? What's the opportunity cost or lost in the money that you're investing? So for us, it's you can buy something that doesn't cash flow today if you have a plan to increase it, but you got to be careful on the value add strategy or the forced equity strategy, because those are largely off the table right now. Not in all cases, but in a lot of cases. So I always measure it with what's, when bank accounts were at less than 1% and they were paying less than 1% on your actual savings, then that made a lot of sense. I mean, I would invest in 3 and 4% real estate, let's say, or 5 or 6. But now you've got that as a competitor. So you always just got to take a look at the cost or the lost opportunity cost of the money itself.
So our next question comes from Edward. And those listening on YouTube, go ahead and ask some questions, and I'll try and answer them. Edward said, I have a paid off second home, so can I get a line of credit about $120,000? Is this a good way to get my first rental using that line of credit?
So, yes, it is. Danille, you've done this. It depends on the cost of again, going back to the cost of the money. It's your money, by the way. Don't forget, it's your 120. It's your equity, your money. So, and then of course, what are you going to do with that? So if you're going to pay 6-7% for that money and you're going to get 2 or 3, it's probably not a good idea.
Well, also the risk too is in a lot of home equity lines, they're not fixed. So you don't want to put variable debt on right now, I would argue. That's a lot of money for variable debt. Now, if you can pay it off in a year, 2 years, whatever, you're fine. But most people for $120,000, they're thinking doing like a 10-year, 15-year payoff period. And that can be really risky right now. You might want to look into it, though, because I did have a home equity line where I could lock in a rate after I put the money on, but it was a little bit over what a normal mortgage would be, and mortgages are high right now. So now you're probably looking at 9 or 10% to lock it in, which is high. So I don't know if now's the best time to do that. One thing you could look into doing, but I would probably wait until rates go down, is a cash out refi of your own mortgage. And then you have cash in hand at a low rate that's fixed for 30 years, and you can buy something with that. But it is a little bit risky to use adjustable.
One last thing. I love the question, because if you can use that money for, say, 3, 4, 5 months, then it probably works. So if you can replace it out and just use it as a short-term line, then it makes all the sense in the world. But if it's something that's going to be long-term, I would probably not, if it's, so what would that be like? That might be like buying something well below market and then putting fixed debt on that, and then doing, as Danille said, some kind of cash out refinance on maybe the where that money's going. So I always look at, where's that 120 going to go, right? And then also, is your tenant covering that? That's the other piece. Like, you said it's a second home, which is great. So hopefully, if it's rented, I hope it is, you're going to want to make sure that that's covered. You don't want any financial exposure. You just want to be able to have access and use the line for something on a short-term basis, some kind of quick turn.
Absolutely. So our next question comes from Ashley, and she is saying, my landscaper told me that my tenant's dog had puppies. What do I do?
Make sure they give them away?
Yeah.
No, I don't know. Like, it's going to fall back to the lease. So hopefully you have a clause about pets in the lease. And if you don't have a pet addendum, you should. And I'm sure you guys should just go on the internet and find those. There should be language. There's definitely language in there, because obviously you have in our lease, it's very specific. There's 1 pet or 2 pets, let's say. I think we have a 2-pet maximum. So it just boils right back to the lease. Try not to, don't get too emotional. Just send a simple letter. I would first check. I wouldn't go off of what the landscaper said. I'm sure they're right, but I would just go, you got to go. That's part of being a landlord, going over there, sitting them down and say, what's your plan here? And you could also piss them off if you just send them a blind, angry letter. So just go over there, and maybe that's true, but maybe they've already found homes for them all. You just don't know, right? Just go, rather than damage the relationship. I think tenants are gold, personally. They always will be. They're the ones who pay off our stuff. So that's how I would approach it. But it all does boil down to your lease.
And you also want to do a walkthrough of your house, right? You want to make sure there's not damage from the puppies because, on your lease, you state the 2 or 1 or however many dogs you have and what kind of dogs they are. So technically, those puppies are not allowed on your property because they were never approved. And I agree with Ken. Chat with them, whatever, see what the plan is. But you also want to make sure you don't have damage from puppies if they've been letting them run all around.
If it's a great tenant, I would work with them.
Yeah.
And just go address it and just sit down with them and say, hey, heard you had puppies, and that's it. And then just have an open dialogue. But you do need to know your rights, which is go back to the the lease and take a look.
Yeah. And if they refuse to get the puppies out, you do have a right to start some kind of eviction process because those are not allowed on the lease.
Yeah.
So.
Most of the time, people don't keep all the puppies, right? There's usually a point. So, but you never know.
Maybe she's a dog breeder and she just didn't tell you.
Could be, yeah.
Anyways, we'll see you guys next week. Thanks for...
Cheers.